33,204. That is the number on your screen right now if you pull up the gold spot price. And if you check silver, you see 30 bonds, 40. Those are the official numbers. The numbers the mainstream tells you to trust. The numbers that financial television anchors read off a teleprompter with total confidence. But here is the part they do not tell you. In Shanghai this morning, gold is commanding a premium of $47 per ounce over London fix. In Mumbai, physical silver dealers are turning away buyers because they cannot source product at anywhere near the COMEX paper price. And on the COMEX itself, the exchange where the official price is actually set, the registered silver inventory just dropped to 133 million ounces. That sounds like a lot. Until you understand that open interest on paper silver contracts represents a claim on over 47 billion ounces. Let me say that number again. 47 billion ounces in paper against 133 million real ounces in the vault. That is a 356-to-1 ratio. Paper says one thing. The vault says something very different. And the gap did not close overnight. It widened. If you are watching this and you are staring at red on your screen right now, if you bought silver at $34 or gold at $3,300 and you are questioning everything, I need you to stop for a moment. Because what looks like a bottom might actually be the most critical signal this market has generated since 2008. But you have to understand what you are actually looking at. Because if you are reading the price, you are reading the wrong number. Welcome to the hidden economy. The real story is never on the surface. I break down what the institutional players are actually doing. The data they file, the positions they hold, the moves they make at 3 a.m. on a Tuesday, so that when you see the headline, you already understand the story behind it. Subscribe right now and hit the notification bell, because what I'm going to show you in the next 18 minutes does not exist in a single mainstream financial publication. Let's go. Here is the thesis of this video, and I'm going to state it plainly before we build the evidence. The price you are looking at right now is not the bottom because sentiment turned. It is not the bottom because the Fed blinked. It is the bottom, if it holds, because the physical market has completely decoupled from the paper market, and the institutions that have been running the short side of this trade are facing a delivery problem that paper contracts cannot solve. This number doesn't exist in a fair market. A 356-to-1 leverage ratio on a physical commodity is not a market function. It is a structural fiction. And structural fictions in commodity markets have exactly one ending. They end with price discovery, real price discovery, the violent kind. Let's start with the data anomaly that triggered this video. On April 3rd, COMEX registered gold inventories. That is the gold that is actually available for delivery, not just eligible gold sitting in vaults, fell by 12. 3 metric tons in a single session, 12.3 metric tons in one day. That is not normal outflow. That is not routine settlement. To put it in perspective, the entire registered gold inventory at COMEX is now sitting at approximately 8 million troy ounces. And the open interest, the paper claims against that gold, represents demand for 62 million ounces. So you have 8 million real ounces, and 62 million paper claims on those ounces. That is a 5-to-1 gold leverage ratio, which, compared to silver's 356-to-1, might sound manageable. But here is what should concern you. The gold ratio just jumped from 2. 1-to-1 to 3. 5-to-1 in under 6 weeks. The acceleration is what matters. And then something strange happened to the vault numbers. 3 days after that, 12. 3 metric ton outflow, a reclassification appeared in the COMEX data. 4, 1 million ounces of silver moved from eligible to registered. On the surface, that looks like the vaults are being restocked. More silver available for delivery, right? The shorts are covered, but here is the part that should concern you. That reclassification happened on a Friday afternoon at 4:47 p.m. Eastern Time, after market close. After the weekly shot, commitment of traders report had already been filed with the CFTC, which means that position change did not show up in the publicly available data that retail traders use to assess market structure. Wall Street is not confused. They know exactly what this means. Why does any of this matter to your portfolio right now? Because if this is a genuine bottom, and I'm going to show you why the physical data suggests it might be, then the investors who understand what they are looking at will position differently than the investors who are just reading the price action. The first group will see a buying opportunity at $31, 40 silver. The second group will see a chart that looks like it could drop another 15%, and they will wait. One of those groups is going to be right. History tells us which one, but that's not the part that should concern you most. Let me show you the pattern, because this is not the first time these exact conditions have appeared. And every time they have appeared, what followed was not just a price recovery. What followed was a restructuring of who holds real wealth. Go back to August 1979. Gold is trading at $307 an ounce. Silver is at $9. 17. On the surface, the market looks broken. Hunt Brothers have been accumulating physical silver for months, but the paper price is still anchored to what the big commercial banks say it should be. The paper shorts are enormous. The leverage ratio on silver is estimated at over 200-to-1. Sound familiar? What happened next became one of the most studied commodity events in modern financial history. By January 1980, silver hit 49, 45. Gold hit 873s in less than 6 months. And the investors who had been staring at that flat suppressed price thinking it would never move, they missed the entirety of that move. Same playbook, different decade. Now go to April 2011, silver peaks at 49.51, almost exactly mirroring the 1980 high. But look at what happened in the 6 weeks before that peak. The Shanghai premium on physical silver was running at $2, 10 to $2, 80 per ounce above the COMEX price. Premiums at US coin dealers were averaging 22% over spot. The COMEX silver registered inventory had fallen to 41 million ounces, the lowest level since 2008. And then the CME Group, the parent company of COMEX, hiked silver margin requirements 5 times in 8 trading days. 5 margin hikes in 8 days. When a regulator hikes margins once, it is responding to volatility. When they do it 5 times in 8 days, each hike forcing leveraged longs to liquidate or post more cash, that is not a regulatory response. That is a market intervention. And the beneficiaries of that intervention were the entities that held the largest short positions at the time. The premium held through the entire dump. Even as the paper price fell from $49 back to $32 in a matter of weeks, the physical premium at dealers never compressed below 18%. Because the buyers of real silver did not panic. They understood what was happening. The paper was being repriced. The metal was not. Once you understand the ratio, the price action makes sense. Now, here's where it gets directly relevant to what you are watching right now in April 2026. The current Shanghai silver premium is running at $2, 43 per ounce. That is the highest it has been since March 2022. Chinese physical silver demand in Q1 2026 came in at 2,147 metric tons, a 34% year-over-year increase. Solar panel manufacturing alone is consuming silver at a rate that analysts at Metals Focus estimate will produce a 215 million ounce structural deficit for the full year 2026. 215 million ounces of structural deficit in a market where the COMEX registered inventory is 133 million ounces. The West is still pricing this like 2019. The East stopped pricing it that way 18 months ago. Here is what they filed at 3 a.m. that nobody is talking about. In the most recent bank participation report, filed monthly with the CFTC, covering positions held by US banks in commodity futures, the net short position in silver held by US banks sits at 26,147 contracts. Each COMEX silver contract covers 5,000 ounces. Do that math, 26,847 contracts times 5,000 ounces equals 134. 2 million ounces of silver sold short by a small group of US financial institutions. Let me compare that to something real. The entire annual silver mining output of Mexico, the world's largest silver producing country, is approximately 180 million ounces. These banks are short the equivalent of 75% of Mexico's entire annual mine production. On paper, with no intention of ever delivering a single physical ounce, this number doesn't exist in a fair market. And here is where the pattern becomes impossible to ignore, because I need you to stack these data points together. Data point 1, COMEX registered silver inventory at 133 million ounces, the lowest since Q3 2022. Data point 2, US bank short position of 134. 2 million ounces, essentially a 1-to-1 bet against the entire registered inventory. Data point 3, Shanghai physical premiums at a 4-year high of $2, 43 per ounce. Data point 4, global silver structural deficit projected at 215 million ounces for 2026. Data point 5, solar, EV battery, and AI data center silver consumption collectively up 41% year over year, according to the Silver Institute's March 2026 demand report. 5 data points, 5, and every single one of them points in the same direction. Tightening supply, accelerating demand, paper price suppressed by a concentrated short position, physical premium expanding, Eastern accumulation accelerating while Western paper traders set the official price. Now ask yourself the question that the financial media will not ask. Why did JP Morgan reclassify 13 million ounces of silver from eligible to registered in February? And then watch 9. 7 million ounces of registered silver leave the vault in March. That is not random inventory management. That is a sequence. Reclassify it so it appears available. Let it leave. Report the eligible inventory to regulators as a buffer. Meanwhile, the net physical position tightens further. How can 356 paper claims exist for every real ounce of silver? The technical answer is because the CFTC allows it. Because the presumption is that most contract holders never intend to take delivery. They are speculating on price direction, not acquiring metal. And as long as everyone plays by that rule, the system functions. But the rule is breaking down. In 2023, physical delivery requests on COMEX silver came in at 127 million ounces. In 2024, that number was 168 million ounces. In the first 3 months of 2026 alone, delivery requests are tracking toward an annualized pace of 240 million ounces. The system requires the assumption that most holders will not stand for delivery. What happens when they start standing for delivery at double the historical rate? What happens when the Asian buyers, who have been quietly, patiently accumulating, decide that the paper price is so disconnected from physical reality that the only rational move is to convert paper into metal? The gap didn't close, it widened. And here's the historical parallel that should make every person watching this very attentive right now. In the 18 months before the 1980 silver peak, 4 critical conditions were present. 1. Concentrated commercial short positions that defied normal market logic. 2. Physical premiums diverging from paper price. 3. Eastern demand, primarily from Middle Eastern sovereign buyers at the time, absorbing supply faster than it could be replenished. 4. A US dollar under pressure from structural deficits and inflationary monetary policy. In April 2026, all 4 of those conditions are present. Simultaneously, once as accident, twice as coincidence, 3 times as policy. But there is something different this time, something that did not exist in 1979 or 2011. China is now the world's largest gold buyer, the second largest silver consumer, and holds an estimated 4,300 metric tons of official gold reserves, with independent analysts suggesting the actual figure may be closer to 7,000 metric tons when shadow reserves are included. India absorbed 400 metric tons of gold in 2025 alone. Russia has been converting oil revenues into physical gold for over a decade. The West is still pricing this like 2019. The East has been pricing it like 2029 for the last 2 years. And that structural divergence between where the paper market says the price should be and where physical demand says the price needs to be is what creates the conditions for a bottom. A real bottom, not a sentiment bottom, not a technical support level bottom, a physical reality bottom. But that's not the part that should concern you. What should concern you is the mechanism by which the resolution happens. Let's talk about what happens next. And I want to be precise here, because there are 3 categories of people watching this video right now. Type 1, you are scared. You bought silver at 34 or gold at $3,350. You are watching the paper price and you are thinking about selling before it drops further. You are reacting to the number on the screen, not to what the number represents. Type 2, you are frozen. You have been waiting on the sidelines. You have been telling yourself you would buy when it pulled back. Now it has pulled back, and instead of acting, you are waiting for confirmation, some signal that this is definitively the bottom before you commit. Type 3, you understand what you are looking at. You have watched the premium data, you have tracked the COMEX inventory, you know that the paper price and the physical price are diverging, and you understand that divergence is not a warning sign about gold and silver, it is a warning sign about the paper price itself. The people who actually built wealth through the 2008-2011 metals cycle were type 3. They were not lucky. They were reading the right data. Here is what the data says should happen next. When a paper market becomes so disconnected from physical reality that the delivery mechanism starts to strain, when the entities holding paper claims begin converting to physical at an accelerating rate, the paper price does not gradually converge with physical reality. It reprices quickly, because every basis point of convergence creates more urgency for the remaining paper holders to convert before the next move. We saw this in 2010 to 2011. Silver went from 1850 to 49s, 51 in 14 months. Not because sentiment changed, not because retail investors suddenly discovered silver, because the structural imbalance between paper supply and physical demand reached a point where orderly repricing became impossible. The question is not whether this repricing happens. Physical fundamentals in 2026 are stronger than they were in 2010. The silver structural deficit is larger, the industrial demand is more deeply embedded in supply chains that cannot substitute other materials, and the Eastern accumulation is more organized and more patient than anything we saw in 2010. The question is timing. And on timing, the data is giving us specific signals. Signal 1, the April 2026 COMEX delivery month. Silver contract holders have until April 25th to declare their delivery intentions. Based on the open interest as of this week, the potential delivery demand in April is tracking toward 9,400 contracts, representing 47 million ounces of silver that contract holders may request in physical form. The registered vault inventory that can actually satisfy those deliveries is 133 million ounces. That sounds fine until you account for the 26,000 plus short contracts held by US banks that would face their own settlement obligations if the longs stood for delivery en masse. April 25th is the date you need to watch. Signal 2, the Federal Reserve's May 7th meeting. The market is currently pricing in a 68% probability of a rate hold. If the Fed holds and the dollar index stays elevated, that historically has been used as a justification for continued paper price suppression. The short side of the silver trade is partially funded by the dollar carry trade. A strong dollar gives them cover, But here is what is different. Physical demand does not care about the dollar index. Chinese solar manufacturers are not buying silver in fewer quantities because the dollar is strong. They are buying in yuan, and the yuan-denominated silver price just hit an all-time high. Wall Street is not confused. They know exactly what this means. Signal 3, the mining supply constraint. Global silver mine production in 2025 came in at 844 million ounces, slightly below the 848 million produced in 2024 and barely above the 833 million produced in 2023. Mine supply has been essentially flat for 3 years. Investment in new silver mining projects is running at its lowest level in a decade because the suppressed paper price has made project economics look marginal on spreadsheets. But you cannot suppress price permanently without suppressing supply. And suppressed supply is what turns a manageable deficit into a crisis. The West is still pricing this like 2019. The miners stopped building new mines at 2019 prices. And we are now in 2026, with 2026 demand levels, trying to be satisfied by 2019 era production capacity. This is the impossibility at the core of the current structure. Signal 4. And this is the one that nobody is talking about. In March 2026, the Shanghai Gold Exchange introduced a new physical silver contract denominated in yuan, settled exclusively in physical metal, with delivery requirements within 5 business days of expiry. No cash settlement option. Physical only. This contract drew 2 billion yuan in open interest in its first 30 days. The SGE has not publicly announced it, but market participants with access to the exchange data report that the buyer side of this contract is dominated by sovereign adjacent entities, not retail. Not funds, sovereign adjacent. Paper says one thing. The vault says something different. And in Shanghai, they are building a vault that bypasses the Western paper market entirely. What does this mean for you right now, specifically? If you hold physical silver or gold, you are holding the asset that the paper market is mispricing. You are not losing money on paper. You are holding something that is worth more than the paper system says it is, and the premium data in Asia proves it every day. Your job right now is patience. The premium held through the entire dump in 2011. The physical holders who understood what they had did not sell. The ones who read the paper price and panicked sold their metal at the exact bottom and then watched silver go from 32 yuan back to $49 in 18 months. Do not be the person who sells real money to protect paper money. If you hold silver ETFs or paper gold vehicles, understand what you actually own. You own a promise. You own a financial instrument that gives you exposure to the paper price, the same paper price that is 356 times leveraged against physical reality. In a normal market environment, that is fine. But the conditions we are describing are not normal market conditions. They are the conditions that historically precede a breakdown of the paper system's ability to deliver. If and when that delivery mechanism breaks, the paper price and the physical price will diverge sharply, and the paper vehicle you hold may not track the physical price the way the prospectus implies. Know what you own. If you are a leveraged trader, I am not going to spend much time here except to say this. You are playing a game designed by people who can change the rules in real time. CME hiked margins 5 times in 8 days in 2011. They can do it again. If you are leveraged long, understand that your position can be liquidated before the price recovers, even if your thesis is correct. The volatility of a market repricing from structural imbalance is not the same as the volatility of a market moving on news. If you have been waiting on the sidelines, this is not financial advice. Your money, your decisions. But I will tell you what the data says. The structural deficit is 215 million ounces. The registered inventory is 133 million ounces. The Shanghai premium is at a 4-year high. The delivery demand is accelerating. And the paper price is at $31.40. If those fundamentals are correct, and these are not opinions, they are filed numbers, exchange data, and trade statistics, then the question of, is this the bottom, may be less important than the question of, how much of this story do I want to miss waiting for certainty? There is no certainty. There never is. But there is data. And right now, the data is telling a very specific story. If you are someone who bought at higher prices and is questioning your decision, I want you to understand something important. The reason you bought was presumably because you understood at some level that the monetary system has structural problems, that physical assets have intrinsic value that paper assets do not, and that the long-term trend favors hard assets over fiat currency. None of that has changed. The paper price is lower. The structural case is stronger. Those two facts are not supposed to go together. But in a market that is managed by a 356-to-1 leverage ratio, they can. They have before. And every time they have, the resolution favored the patient holder. Subscribe to The Hidden Economy. I am going to keep breaking down exactly what the big players are doing so you are never caught off guard again. This is the kind of analysis you will not find anywhere else because it requires reading the data the institutions file, not the headlines the institutions want you to read. Now, let me close with the frame that I think puts everything in this video into context. There are only two explanations for the current state of the gold and silver market. Explanation 1, the paper price is correct, the $31. 40 silver price accurately reflects global supply and demand. The 215 million ounce structural deficit estimate is wrong. The Shanghai premium is a regional anomaly. The COMEX delivery data is not signaling anything unusual. The 356-to-1 leverage ratio is normal and sustainable, and the 26,947 contracts of commercial short interest held by US banks is simply sophisticated hedging with no market manipulation implications. Explanation 2. The paper price is a managed number. It is managed by entities with enormous short positions who benefit from lower prices to cover those positions. The physical market is telling the truth through premiums, through delivery demand, through Eastern accumulation patterns that have been consistent for over a decade. And the bottom we are looking at is not the result of organic selling pressure. It is the result of paper volume applied to a market where real physical demand is accelerating. I cannot tell you which explanation is correct. I can tell you that the data fits explanation 2 far better than it fits explanation 1. And I can tell you that every time in recorded financial history that a physical commodity has traded at this level of paper to physical divergence, 1979, 1980, 2008, 2010, 2011, the resolution was not orderly. It was not gradual. It was sudden, and it was violent, and it moved the price in the direction of physical reality. The script is not new. The playbook is not new. Wall Street is not confused. They know exactly what this means. The question is whether you do. Drop your silver target for 2026 in the comments right now. I read every single one. And tell me, after watching this, do you still believe the price you see on your screen is the real price? Or is it just the number they want you to believe? Send this video to one person you know who is watching the gold and silver price right now and feeling panicked because they are reading the wrong number. And they need to understand what the vault numbers actually say. Hit the like button. It costs you nothing, and it helps this channel reach the people who need to see this analysis before April 25th. Because here is the thing that keeps me making these videos. Most people will never see this information. The mainstream financial media will not cover a 356-to-1 paper-to-physical ratio. They will not report that the Shanghai Gold Exchange just launched a yuan-denominated physical-only silver contract that drew 2 billion yuan in its first 30 days. They will not tell you that COMEX registered inventory is at its lowest level in nearly 4 years, while commercial shorts are at their highest concentration in over 2 years. They will not tell you, but you saw it. The West is still pricing this like 2019. The East has been pricing it like 2029 for 18 months. The only question that remains is which price is right. And on April 25th, when the April COMEX silver delivery window closes, and we see how many of those 9,400 contracts actually stood for delivery, and how much physical actually left the vault, we will have the next piece of the answer. I will be here when that data drops. Make sure you will be too. Right now there is one more number buried in the April COMEX filings that I have not shown you yet because it deserves its own video. It is a single line item in the warehouse receipt data that has appeared only 3 times before in the last 20 years. The first 2 times it appeared, what followed changed the precious metals market for years. The third time is now. That video drops this week.